And thanks for joining Thompson Hine's weekly coffee chat series. My name is Mark Miner, and I'm a senior counsel in Thompson Hine's investment management and business litigation practice groups. Joining me today is Richard Heller, a partner in Thompson Hine's investment management practice, and Anthony Scaramucci, founding and managing partner at Skybridge Capital. We're delighted to host our distinguished guest today for what promises to be a riveting discussion. No pressure.
But just for people's benefit that may not know me, if you've been under a rock the last 5 years, I'm the founder and managing partner of Skybridge. It's a $9 billion hedge fund, private equity business. We obviously own the SALT conference. We've done that conference 14 times. And the one that we're about to do is here in September at the Javits Center, which I think will be very exciting for people, September 13th to the 15th. We think we'll be fully open then, and obviously we'll take the health and safety precautions to allow people to attend. And one of the more interesting things about that conference in 2017, I hosted then former Vice President Joe Biden. So I got the opportunity to spend a lot of time with Vice President Biden over those 3 days at the SALT conference. So that's a quick summary. Mark, take it over to you. What do you want to talk about today?
Thanks a lot, Anthony. And thanks, Richard. I'm sure the comments were scintillating, the ones we missed. Anthony's check is in the mail. So, Anthony, today we're going to dive into how private equity is responding to digital currency disruption, what the Biden administration should mean for practitioners in the space, and a little bit about the pandemic effects on private investment generally. With the extent of COVID's implications still unfolding, we'd like the panel to share their perspectives on what's ahead for private equity markets and regulation and potential shifts in sectors that might be hot or not, including healthcare and technology. For those who are listening in, if you have questions or comments today, I encourage you to join in by using the Q&A box on the control panel, and we'll address the comments as we move through the discussion. I'll try to leave a few minutes at the end too, to get to questions that we didn't get to during the conversation. The session is expected to go till about 11:15, and we promise to follow up with any questions that we don't get to with our time together. So with that, let's get started. So between the pandemic and social upheaval, the presidential election, the post-election insurrection, and all this has roiled the country, markets have been incredibly resilient. And so even as of yesterday, the S&P, it hits an intraday high before the Fed issued some monetary policy. But private equity has clearly been drawing its own winners and losers during this time. What are you both seeing that's hot and lagging in markets of interest in private equity? I'll start with you, Anthony.
Well, I think let me just give a precursor, a little bit of a backdrop. I think this is important. And I will say this about Skybridge. We had the worst year of the life of Skybridge in the month of March of 2020. So we managed to pack a horrific entire year into that 31-day period. And that would be, the beginning of the debacle, which led to the COVID-19 pandemic and the uncertainty about the markets. The Federal Reserve has added $2.5 trillion to its balance sheet since then. They probably put $4 or so trillion into the markets in a form of stimulus. And then, of course, you have the fiscal side of the equation, where right now I've counted about $3.5 trillion of stimulus has clicked into the, could be individuals, it could be PPP into small businesses, et cetera. And so the forces of that have driven up asset prices. And so this is a halcyon period for private equity. It's a halcyon period for hedge fund managers, frankly. If you've owned assets and you were smart enough to stay in those assets after the March 2020 debacle, you've done very well. And I think you're going to do very well over the next 24 months, Mark, primarily because you've got all this pent up demand. And once the pandemic ends, I think you're spring loading for a massive amount of consumption. Think of the new Roaring '20s. But for us, I could just talk specifically about Skybridge. We have spent most of our time on the private equity side in fintech and understanding the next evolution of what is taking place in the banking business, what is taking place in the way we're going to do transactions in the future. And, the bad news for people like Amazon taking out the time and energy to travel to a bricks and mortar store, a lot of the fintech stuff that's happening right now is going to make things a lot more efficient and will cut and take out lots of costs. And it'll either force the traditional banks to restructure and right size, or they'll get meleeed. Think of the Pacific Bell Yellow Pages. It's reminiscent of Jerry Yang driving from Stanford University to Pac Bell's corporate offices and explaining to them, well, I've got this algorithm. You can punch in a name and then the phone number will spit back out to you in the computer. And the Pac Bell people laughed him out of the room. They said, well, we're killing millions of trees, and then we dye the paper yellow and we ship out 4-pound paper books to all of our customers. We don't need you, Jerry Yang. And of course, they were meleeed by that. So for me, you have to deal with the world the way it is, not the way you want it to be or not the way you think it should be. Should the federal government have expanded their balance sheet like that? Should we be spending this money at the federal level like this? We can debate that, but it is happening. And so a result of which you now have to respond to the world the way it is, not the way you think it should be or the way it ought to be. And so for us, we're deep diving into fintech on the private equity side, Mark.
That's fascinating. And, there's some people who are also concerned about whether or not the money that's been injected into the markets, though it may have been necessary, is kind of an artificial prop up, right? And so at the end of the day, there are questions about what is going to win out: pent up demand, when we're all able to go out and be consumers again and parts of the economy are working, versus that balloon basically contracting right back. Do you have any thoughts on that?
Yes. So what I would say is what we sometimes get wrong as analysts or as money managers is that artificiality and thinking that it's not sustainable. But what I have found over 33 years of doing this, less my 11-day disaster in the White House, is you have a self-fulfilling prophecy to that sustainability. So if you are fueling that kind of growth or that type of stimulus, then what ends up happening is you're starting and priming a virtuous circle of consumption, capital spending, which leads to growth, which leads to economic innovation, which leads to more consumption and leads to more capital spending. And so we can debate whether or not it's long-term sustainable. There are modern monetary theorists out there. I'm good friends with Professor Stephanie Kelton. She's actually a partner of mine in our research think tank that we call Strategic Worldviews. Professor Kelton is a best-selling author of The Deficit Myth, and she explains in her book, which is now in paperback, how the government should not be run like a business or should not be run like a personal household, that the government does have tremendous flexibility on its balance sheet to create deficit spending, which does fuel economic activity. And I'll just point out to everybody, we have not paid back any debt. So the debt that we incurred in the 1930s, never paid it back. The debt we incurred during World War II, we never paid it back. But what we've been successful at doing is growing the economy to outpace the debt service. And now the question is, are we getting to such size in terms of the amount of debt? Are we able to still do that? And if you're a modern monetary theorist listening in, well, yes, the answer to that question, we can do that. I can explain why if people want to hear that. I'm not a modern monetary theorist, but I am a realist. I do recognize that the United States, despite listening to cable news at night where we beat our brains in and we feel terrible about our country, the United States is still the font of economic innovation. The United States is still the destination for immigrants from all shapes and sizes and classes and countries. They want to come here to experience the opportunities here in the United States. And if we can get some of these policies right long term, the next century, frankly, will be America's best century. And again, I'm not a politician, so I'm not saying that with any jingoism. I'm saying that through just solid economic analysis and evaluation. I think the big issue for us, Mark, is how are we going to make sure that this economic abundance that's coming is spread out and made deep enough in our society so that the small group of people at the tippy top aren't taking all the economic rent and all the excesses, if you will. How do we make it deeper? And how do we do that through market forces as opposed to having the government impose that upon us? Because once they do that, they disrupt the free market system. And then it has the vicious circle where once things are disrupted, people start leaving and they start moving. That's the big issue with taxation, as an example. I have no problem paying the taxes, but you better deliver services to people for these taxes. If you don't, they'll seek areas of the country or areas of the world where the taxes and the services are aligned up appropriately.
I took a look this morning at the top 10 kind of call outs from President Biden's speech last night, and the discussion about the top 1% and kind of the reallocation of tax distributions, equitable and fair, definitely came up. And if we have time at the end, I'm going to give you a little speed round from that speech. So clearly, you've taken a look at what's in the market and have decided that fintech is the space that you want to play significantly in, and it's obviously grown tremendously. Let's talk a little bit specifically within that category about digital currency. You've obviously been very bullish in the press about the prospects and future for digital and crypto. The CFTC a couple of years ago stakes out its primacy in the space, and now the SEC and Treasury are weighing in a bit. What are you seeing that still has you leaning in to the future of currency alternatives with this unknown kind of growing regulatory environment?
So I think you have to really step back, and I will tell people on this call that I started out as a Bitcoin skeptic. I didn't fully understand it in the beginning. When the Winklevoss twins came to the SALT conference and they were buying Bitcoin 2012, 13, and 14, and they were explaining to me what they thought the future was for Bitcoin and other digital currencies, I was a skeptic. I remember writing down, well, if they're right, if Bitcoin starts to scale pursuant to Metcalfe's law, and just for everybody's benefit, Professor Metcalfe said that you can measure things fundamentally by the exponential growth of their networks. And so Amazon would be a good example of this, Mark. Amazon, I was in a meeting, the Sun Valley Media Conference, 1999. A gentleman by the name of Jeff Bezos was making a presentation. People were pushing back on him, and they said, well, your company's not making any money, and you're borrowing money, and you're issuing debt and equity to scale the company, but it's not making any money, and so therefore your valuation is too high. And at that point, people were skeptics because Amazon, even at that time, was being valued from a market capitalization greater than Sears Roebuck. And there was Sears Roebuck with all these bricks and mortar stores and this great history as a retail legend. And so how is that possible that you should be valued like that? He said something elemental. And if you understood it, you made a lot of money with Jeffrey Bezos. He said, well, I'm going to scale this pursuant to Metcalfe's law. If I can get billions of people on this platform, it will eventually become quite profitable, and I will dominate the internet retail space. Well, today he's got 46% of that. If you put $10,000 in Amazon on May 15th, 1997, when it came public, today that's worth $21,140,000. I'm bringing that up because Bitcoin is a lot like Amazon. It is scaling pursuant to Metcalfe's law. And so when I looked at Bitcoin in the beginning, I was a skeptic, but when it got to 100 million users, which was back in the summer of last year, I turned to my team. I said, we need to have a Bitcoin fund. We need to have exposure to Bitcoin. If the Skybridge economic team is right and there's 1 billion users of Bitcoin, well, given the limited supply and the fact that you can't make any more coins, those coins should be worth a tremendous amount of value. And so it'd be very hard for me on a call like this to explain to people why, but I would encourage people to read about Bitcoin. One book in particular that it's a good primer. It's a very explanatory, is Dominic Frisby's book, Bitcoin, The Future of Money. And if you go to Amazon and buy it for $14, I think you'll be very well served. It'll take a few hours to read it, and he'll explain to you the history of Bitcoin, the history of digital cash, if you will, or digital currencies. He'll explain to you what failed prior to Bitcoin. There were MySpaces, if you will. There were Ask Jeeves before the Facebooks and Googles, and same with digital cash. And I think what Dominic does in the book is he illustrates why Bitcoin is going to be a success. And what I love about that book, Mark, it was written in 2014. And so he predicted the last 7 years of activity. And this is the reason why I recommend this book to people. And what I would say to you, I may be wrong. I'm not a Bitcoin evangelist. I don't think that Jesus and Moses had a baby and the baby was Bitcoin. That's not me. I'm a Bitcoin investor, and I recognize that there are issues. I recognize there are risks. I recognize there are volatility. But what I tell my clients, if this is scaling the way Amazon scaled, if this is a monetary network the way Amazon is a retail network, or Facebook is a social network, if we're right about this, you need to have some exposure, 0.5%, 1%. If I'm wrong and Bitcoin is rat poison, Warren Buffett says that it's rat poison. If I'm wrong and Bitcoin somehow trades to zero, well, if you have 1% exposure, you're okay. But if I'm right and Bitcoin goes 10 to 1 on where it is today, and these coins are worth $500,000 over the next 5 years, I think you'll be well served having some Bitcoin in your asset allocation. So I'm not going to do a wonderful job of explaining why I'm so confident of this, but I would implore people to please read about it. And I think once you read about it, you'll either have your eureka moment, you'll be part of it, or as Bill Miller said over the weekend in his interview with Barron's, people were hating on Amazon until it got to 3,000. Now all institutions love Amazon. But it was a good 15 years of volatility and uncertainty before Amazon got to where it is.
It's interesting that you mentioned that. It's obviously earnings season, and institutions are reporting out. I think Apple reported yesterday.
Good number last night. They had a very good number last night, and they're buying back $90 billion of stock. It's very favorable.
Right, and Amazon is coming up, and so it's interesting how even some of these institutions that built their business on brick and mortar or hardware, how are increasingly adding these technology services and delivery streaming to capture where the market is moving, and so maybe crypto is sitting at the center of that. And rat poison is a pretty strong phrase, but there are major institutional players, to your point, who are still a bit skeptic. There was recently announced a large institution that was willing to dip its toe into the water, and so applying for a Bitcoin ETF, and so people begin to see confidences in the market. There was obviously a big splash with the IPO of Coinbase that showed some promising but mixed results about how industry was going to adopt that model. So what do
by the way, Mark,
market
Mark,
responses say to you about institutions like Coinbase in the future?
Well, listen, I think we're at the advent of something that's happening that's going to be transformational. And so just let me explain this to people. You can transfer value between two parties now over the blockchain seamlessly without a third-party intermediary. And so when you step back and you think about that for a second, that can take out a lot of costs associated with the transfer. Moreover, there's something called the Bitcoin standard, where if money is decentralized and money is standardized, then you cannot corrupt the money. And whether you read von Mises or the white paper by Satoshi Nakamoto or the group known as Satoshi Nakamoto that invented Bitcoin, or even John Maynard Keynes, we'll get to him in a second, what we have found over 5,000 years of human history is governments corrupt the money. They print more of it. They borrow on it. They create debt and credit bubbles that are not sustainable. That's back to your earlier point about where we are right now in terms of the economic cycle. And remember, Nakamoto and that team invented Bitcoin after the global financial crisis. And basically in that white paper, they said, if you're going to produce currency, you're going to print money, well, then you're going to alter people's savings. And everybody on this call should know this. You are being taxed right now by your government. It is a hidden tax. If you've produced 40% more dollars, and 40% more dollars are in circulation today than there were 12 months ago. And again, I'm including, someone will Google that and say, well, Anthony, you're wrong. It's 26.4% more dollars in volume. And I'll say, well, you're right about that. But I'm factoring in the stimulus that was just passed by the Congress and signed by the president. If you build all of that in, you've got 40% more dollars that have been produced than we had over the prior 244 years. And so where I'm coming from and where I think Coinbase is coming from in this new situation is, what if we're right? What if this corruption of money is completely unsustainable? And I'm here to tell the participants here that you've been taxed. Go look at your bank account. Let's say you have $1 million in your checking account. Well, it's worth way less today than it was a year ago. Well, no, that can't be right, Anthony. The CPI inflation numbers are under 2%. Okay, well, go look at collectibles. Go look at Hampton's real estate. Go look at the home that you want to buy in New York City. Take a look at the astronomical uptake in asset inflation, which is always born from fiat currency production. And so, but having said that, your assets related to Bitcoin are fairly stable, because if it took 5 Bitcoins to buy something a year ago, it still only takes 5 Bitcoins, because Bitcoin went up in value from 10,000 to 55,000. My point being, we may be right. There may be a situation. John Maynard Keynes said in 1944 at the Bretton Woods Conference, he said that he wanted the globe to have one currency. It wasn't possible then. The technology didn't allow for it. The governments weren't going to cede that control. But why did Professor Keynes want that? He knew that with a uniform standard, you couldn't corrupt the currencies. You couldn't mercantilistically attack each other the way China has attacked the West. Or the way the introduction of the euro has helped the German export market. My point being, uniformity in currency after Bretton Woods, 1944 to 1971, before Nixon took us off the standard, you had great economic growth, great economic prosperity. In the last 50 years, we've taken the dollar down 98%. The dollar was buying 35 ounces of gold in 1971. Today, $35 bought 1 ounce of gold. Today, it's $1,700 buys 1 ounce of gold. It's a 98% diminution in the value of the dollar. That is a tax on everybody, Mark. So what Coinbase is saying, this introduction to Bitcoin, is that if we're right and Bitcoin scales, people will use Bitcoin as a standard, and it will transfer Bitcoin, toggle it back and forth to the fiat currencies that they need to use in the respective countries.
Well, that's quite a statement, and that's a huge takeaway. We're going down a bit of a rabbit hole if we're talking about the philosophical beginnings. I teach a course on that, and I talk to my students about the philosophical paper that sets out this premise and whether or not monetary policy can really fix it, or whether some universal currency or something like that is going to be a better option at the end of the day. Do we have Rich back on the phone?
I don't think so. No, I don't see him on the participant list.
Okay. So, so we'll see what wins. Obviously, regulators have been reluctant to, fully endorse crypto with definitive guidance. The SEC has started to address some of these issues. A few months ago, they stated that broker-dealers could custody digital assets without fear of enforcement for a few years if they follow these particular guidelines. And so we'll see where that goes. Let's transition a little bit and talk a little bit about ESG. The Biden administration is taking clear steps to indicate that environmental, social, and governance issues are going to be important to his administration, and you see that line running through various of his agencies. How do you see this impact for private equity?
So I would say to you, anytime the government moves like this, assuming all of this legislation and the things that President Biden was talking about last night get approved, I think there will be a seismic move. I'll take you guys back to the early 2000s when President Bush passed tax reform related to dividends. If you remember, dividends were taxed at ordinary income, then they got taxed at a 15% number versus ordinary income, and all of a sudden there was an explosion in dividend products and dividend funds, if you will, and companies that were more focused on issuing dividends. And I think that will also happen here. So I think that there will be a positive explosion. Now, is that good for the world? Is that good for investing? I personally think it is. I have friends of mine, the world's crazy now. We've got anti-vaxxers. I could debate that all day with the anti-vaxxers. Even though I'm not a scientist, I can explain to them why they should get vaccinated, even if they're just trying to protect their children. But then you also have people that don't believe in the changing climate. They don't think that human beings are affecting the climate. Yet the scientific evidence to that is overwhelming. But let's say that you're a climate change denier. What I would say to you, well, don't you want clean air and clean water for your children and grandchildren? You've got Beijing, they're cleaning it up now, but 80% of the children below the age of 12 in the city of Beijing have an asthmatic issue related to air pollution there. So if you don't believe in the changing climate, don't you want to just protect the children anyway? So I think that we have to do this. I think the president is leading on this, which I applaud. And I'm hoping, the cynics will say, well, India, the nation of India, China, they're going to be behind us. They're going to be advancing because they're going to be burning more fossil fuels when we're not. I don't agree with that. I think the time is right now to create this innovation. And I think if we do that, we will leapfrog over everybody in terms of where we need to be.
It's interesting you talk about how some people who believe certain things, may be opposed to some of the movements here in the markets. But it seems to me that, investor engagement is really going to drive how these companies are addressing ESG, particularly if they're larger institutional investors, and they're garnering considerable attention for either activist investor or even to take the GameStop incident, right? Where you have, maybe that wasn't driven by any fundamentals, but it was certainly driven by a sentiment that the hedge funds have been saying are crying foul, and ironically are asking for regulatory intervention. So obviously, what investors are asking the institutions to take a look at, becomes carefully or needs to be carefully scrutinized. And so isn't that really the fundamental that private equity would want to look toward in order to figure out where it needs to position itself on the issue?
Yeah, listen, I think you're making a point that, where is the puck going for private equity, given the regulatory landscape and given everything that's going on in the world vis-a-vis the liquidity, right? GameStop is ultimately a liquidity phenomenon in my mind. It's a combination of targeting where individual shorts were in the hedge fund community, and then the guys at Wall Street Bets creating a bee swarm to squeeze up those people and to force them out of their positions. Okay, and we can say, is it fair or not fair? It feels like it's a group of people that are running against a castle in the medieval times, and all of a sudden they're shooting flaming arrows. They set the castle on fire. That's certainly what it felt like to me. I don't mind it. I think those are market forces. What I would say about GameStop, I don't know anything in the marketplace that went from 22 to 500 in a 3-month period of time. And so if you're an investor, and some of my hedge fund friends were actually long GameStop along the Wall Street Bets people, taking advantage of that momentum. But I think you're asking something more strategic. Given everything that's going on in the world right now, where should private equity be? Where should they be thinking about things strategically? And what I'm saying to people is the economy is iterating itself once again. The Netscape IPO in 1995 caused a massive swing in the U.S. economy. We drove the economy into the internet. We drove the economy eventually into the cloud. Whether it's your law firm or my investment management team, or you pick it. We learned from the pandemic that we can do a lot more from home. We've learned that we can operate with pretty decent efficiency, if at least you're in a white collar situation. Blue collar people, unfortunately, didn't have that luxury. But if I'm in private equity, where I want to go, where I think the puck is going, is the 5G iteration. I'm not talking about 5G that's on this smartphone, which is slightly better than 4G. I'm talking about over the next 3 years, the full transformation to 5G, which is a quantum in terms of the speed, the expeditious transfer of data, the ability to manipulate data either in the motion picture industry, your law firm, my hedge fund. The point being is you're there again. The Coinbase IPO to me was like the Netscape IPO in 1995. We are now moving into a new frontier where we're going to be able to negotiate and transact without third parties. We're going to be able to transfer money back and forth to each other without, frankly, having to go through the banking system. You're going to have software, companies like Plaid, as an example. Very few people know what Plaid is, but everybody's using it. And so if you're transferring money back and forth between your PayPal account and your Chase checking account, as an example, you're using Plaid. It's the operating system that's allowing for all of this connectivity. And so what I would tell people is your brain is designed to be neurally plastic. Don't be a fuddy-duddy. Don't sit in the dark. Don't be anchored to the past. Talk to younger people about where the future is going to be. And from a private equity perspective, put the money in there. That's what I would be saying to people.
Hey, Rich.
Yes, I'm back. Hello. They finally fixed me.
Rich, now that you're back, could you read my introduction, please? Because I was dying to hear all those good things about myself.
It's a little.
No, I'm kidding. Please don't do that. I'm kidding.
A little late for that. But they were very complimentary, pal.
Oh, thank you. I appreciate it, Rich.
Yeah, we've entered into a fascinating conversation about ESG and activist investors or just investor engagement moving the needle, which led us to a little frolic in GameStop. I don't know if you had any thoughts on whether the market manipulator in that case bears any responsibility, or whether or not it's just a mass movement by investors to support something that they believe in. Clearly, the hedge funds thought that they were a victim. What do you think?
If I could, relative to that, Mark, I do represent a number of family offices. And I can tell you that the ESG space has become very, very important to them. There's the social aspect to it, but they also want to make money. So they're selective, I think, about which entities they're investing in, but they recognize the importance of ESG. So that's my 2 cents on that.
Thank you. Thank you. We have a question that came in. I'll just read it here. The question says, how do people in the private equity world view platforms like Carta and ShareWorks? Some would argue that the structure of the private equity market exacerbates the wealth gap by favoring those who are well connected and have certain net worth. The SEC looks like it's beginning to loosen accreditation restrictions. Are we headed toward a world where retail investors will be able to trade in private equity shares freely on a platform like Carta? And if so, how might that disrupt the traditional private equity business? Anthony, you have a thought on that?
Well, I am a champion of that, and so and for people that don't know this, just quickly on Skybridge, what we've done, we started 10 years ago. We were democratizing the hedge fund space, so we created a registered investment product where you could put $25,000 into our fund and then get access to Dan Loeb or Steve Cohen, who have 15 or in some cases $25 million minimums. I always felt, coming from a blue collar neighborhood, that it was unfair that people couldn't invest in those things. And well, they're risky. Well, are they risky? Look at the risk adjusted returns of somebody like Steve Cohen or Dan Loeb. They're not risky at all. If anything, they've managed risk better than other products. And so I'm a big believer that we are not necessarily smarter than people that have less money than we do. There were kids in my neighborhood, Mark, that were way smarter than the kids I went to Harvard Law School with. They just didn't have the same opportunities. I just know that for a fact. So for me, I'm a very big fan of it. I don't think it leads to a catastrophe. If anything, I think it leads to more opportunity for those people. And micro slices of private equity for people like that, I think is very good. And I think it'll be very good for the industry. It'll lead to more capital. It'll lead to more innovation. It'll lead to more growth. This is the thing about the United States that we should not take for granted. The capital markets in the United States are one of the main engines. I didn't like when the President Biden was basically saying, well, Wall Street hasn't grown the country. I'm not suggesting for a minute that it has, but Wall Street has been the arterial flow of capital in the country. If you want to constrict the arterial flow of capital in the country, you're going to diminish economic innovation. Let's go to fracking for a second. They come up with the ideas behind fracking. They go to Wall Street and venture capitalists to raise the money to build the fracking facilities. And again, we can argue whether fracking is environmentally safe or friendly, but the point being, let's go to mRNA technology as an example. We've had mRNA technology around for 15 or 20 years. We had developed fully the SARS vaccine. We didn't have to use it because it worked itself out in the early 2000s. But we took all of that technology and inserted the COVID-19 virus, at least the mechanisms behind that virus, into the vaccine, and we deployed it. People said, well, it got deployed very quickly, but no, it was 15 or 20 years in the making, primarily due to the money that was able to flow into it from investors that believed in it. So for me, less constrictions, more openness on the investment platform will be better for everybody.
Agreed.
We have another question that came in. It's a good, I think it's an interesting one. The SEC seems to be focused on private equity. If you had one piece of advice for Gary Gensler as he steps into his new role as chairman of the SEC, what would it be?
Well, I love Gary. I don't have a lot of advice for Gary because Gary's way smarter than me, Mark. I know Gary a very long time. I worked with him at Goldman Sachs. He taught a course on cryptocurrency at MIT while he was in the interregnum period of the Trump administration. So I have an enormous amount of respect for Gary. I guess the thing I would say to Gary is don't underestimate the people that you think are the hoi polloi. That would be my message to Gary, because I think what ends up happening is we start to become the collective biases of the people that we hang out with. And so if you're a wealthy person and you're hanging out with wealthy people, you start to think and act like them. If you're in a middle class area, well, guess what? You start to do that. But if you're somebody like me that's been able to straddle both, I live 2 miles from where I was raised. I've got cousins in my family that are in the clamming business, the auto glass business. They're making pizzas out here on Long Island. They're in the deli business. You would be blown away about how smart these people are. And so my message to Gary is don't underestimate people's intelligence. Don't think because you're in a salon of Goldman Sachs or Skybridge or Thompson Hines that, the people that are not with it or don't have great common sense or great judgment about their ability to protect their family or grow their household wealth. I think we've got to get away from that. That would be my message. But other than that, I would tell Gary to do what I think he's capable of doing, which is continue to make the investment products safer, more transparent, but also available. Let's make them available.
It's great. It's great advice. We'll just take one more quick question. I see we're just at about time. But to your point of not forgetting the average everyday guy, one of the questions that came in, what is the best way for just a retail guy under 10,000 or so to invest in Bitcoin? Is it mutual funds?
So there's no mutual fund in the United States at this point. There are ETFs available now in Canada. I don't know the procedure for an American investor to invest in those ETFs. I think that for right now, going to platforms like Coinbase or New York NYDIG, NYDIG, I think those are probably the best places to go for right now. Our fund, which is a partnership, we hope to convert into an ETF. I wanted to get my clients in a position to own Bitcoin prior to an ETF approval in the US, because, if we're right, the demand for Bitcoin will be extraordinary. And so I wanted to get the clients in there back in October, November, December when we started talking about Bitcoin. But that our minimums are 25,000. But I do believe eventually they will migrate. Now, since I have an ETF application, and you guys know this, I'm not really allowed to talk about it. I'm sort of in a quiet period. So that's about as much as I can say right now.
Fair enough. Well, if we're at about time, I'll give you a real quick opportunity to conclude. Richard, we've had a lot of conversation about private equity, much of it in technology. Everyone, I think, fully expects there to be more activity in the space by regulators. What regulatory efforts should we expect that may impact private equity over the next few years?
Well, I think it's to Anthony's point that it's what's going to happen at both the federal and state level. People forget that the blue sky folks are out there too, and my sense is that they will, regulate the space. And to Anthony's point, I hope that it's not over-regulated. Because this is the future, and I think that we want to engender the opportunity for folks who are not, as Anthony put it, the hoi polloi, to enter the space. So I think it's an exciting time. I think it's I think today is Biden's 100th day. So I think we have to stay tuned and keep in mind that growth is essential in this country. And again, as I think Anthony said, the middle class built this country. I think, or Biden said it. It's true. Let's give them the opportunity to participate.
Well, thank you very much. Well, that concludes our chat for today. Thanks for those who stayed a few minutes over. We had a number of questions that we didn't get to. We'll make sure that we get those questions answered.
And by the way,
our next coffee chat, huh?
I was just going to say, by the way, Anthony, thank you very much. I really do appreciate your having.
I'm delighted to be here. I'm glad I logged in early though, because as you guys know, I was wearing my Led Zeppelin. This is COVID-19, so I was wearing my Led Zeppelin shirt, and then I realized I was making a formal presentation. So, but I just want everybody to know. I want to leave you with this last thought. I am wearing my champion shorts from 1981 phys ed class, Richard. I just want to make sure everybody knows that. Okay. In true COVID-19,
I'm wearing my
respectable. Yeah, in true COVID-19 respectable fashion. I just want to leave you with that visual before we depart.
Okay.
So, everyone, our next coffee chat will be hosted on Wednesday, May 5th. My colleague Owen Pinkerton will continue the discussion of private equity within the context of registered fund structures. To register for this or future coffee chat discussions, visit the events page on the Thompson Hines website. We encourage you to go visit our library for past coffee chat recordings, which are available on Thompson Hines YouTube channel. Again, I want to thank everyone for attending today and extend a special thanks to Anthony. I'd love to have a whole nother session on your Superman and Muhammad Ali poster behind you. That's amazing.
See that? Well, you can't
thanks to Richard.
You can't see it, Mark, but my wife and I are sitting next to Batman in the picture. I made the artist draw us in there. See that? And that's a very famous comic cover from 1976. But of course, I ad-libbed a few things in there. I took some liberties.
Oh, that's great. So thanks to everybody for attending. When the webinar ends, you will be prompted to take a survey. We would appreciate it very much if you could tell us what you thought. And until then, thanks for joining us for a coffee chat.
Thank you again, guys. Great to be on with you.
Take care.
Thank you.